Assalamu alaikum warahmatullah. Hi, hello, this is Donorings, and this is the first part of Strategic Management series known as MGT790 by AAAGBS students. Strategy. We need strategy in our lives. Why we need strategy is because we need them to simply live, play games, scheduling, and even to manage our family, etc. But what is strategy in a business company's perspective? A company's strategy is the coordinated sets of actions that its managers take in order to outperform the company's competitors and achieve superior profitability. To simply put, strategy is to gain competitive advantage. Before we move in further, this is the book that I am referring to, 22nd edition of Crafting and Executing Strategy, The Quest for Competitive Advantage by Thompson, Peteraf, Gamble, and Strickland. This book is divided into 4 sections, but today we will be focusing Chapter 1 in Section A, the Introduction and Techniques for Crafting and Executing Strategy. Now, Chapter 1, what is strategy and why is it important? As mentioned previously, a company's strategy is to gain competitive advantage, unless if it is a not-for-profit organization like charity bodies. Competitive advantage is the advantage of competitors gained by offering consumers greater value, either by means of lower prices or by providing greater benefits and better servicing facilities that could justify higher prices. 2 examples are Xiaomi smartphones and Apple iPhones. One is more affordable and another is higher priced, especially in the cheapest model comparisons. And both have their own type of competitive advantage. For example, with Xiaomi, the competitive advantage with lower price models, and it is an Android, and the company also have other gears sold at lower prices. Meanwhile, Apple's iPhone is based on unique iOS, and the cheapest model is still twice or thrice the price of cheapest model by Xiaomi and other smartphones. And Apple gears, like smartwatch and AirPods, are also at a higher price. But Apple justified that their products are high priced because of the security and low depreciation value. From this, both have competitive advantage in their own ways, and this advantage is sustainable if buyers prefer company service or products over those of competitors, such as the case of Xiaomi and Apple. The same industry, but different preference of customers. But what happens when a company does not have competitive advantage? Well, the minor impact is that the products and services are considered normal and people might be less interested, resulting in lack of profitability in the market. And the worst thing that could happen is that over time, the company may not be able to sustain the business. As for example, these 2 companies, well known previously, but Nokia and Kodak are rarely heard anymore because they no longer have the competitive advantage in the current market. Now, here is an exercise for you to test yourselves. Can you name one company that failed to compete over time, and why so? You may leave the answer in the comments down below. There are 5 basic company competitive strategies, and they are low-cost provider strategy, broad differentiation strategy, focused low-cost strategy, focused differentiation strategy, and best cost provider strategy. If you could see, these strategies are divided into 2 types of strategy, which are cost and differentiation strategy. But we will be discussing this even further details in Chapter 5, or you may refer for now the textbook in Table 5.1 on page 146. Now that we talk about strategies, do strategies remain constant over time? The answer is no, they don't remain the same over time. They change. But why? It is because the business environments like market conditions, technology advancement, competitors move, buyer needs, and all sorts evolves over time. Let's take an example of Netflix, or shall we say Netflix and chill. Sorry, boomer alert. Founded in 1997 by Reed Hastings and Mark Rudolph, Netflix started as a DVD rental service and was competing with Blockbuster, a larger chain at the time with a larger market share. Netflix even offered themselves to be sold to Blockbuster at one point, but Blockbuster refused to buy Netflix. Netflix then strategized their business, evolved their business model, and with the increasing technology and advancement, and changes in the market, Netflix now is very successful and currently have more than 200 million subscribers and even produce a variety of shows such as House of Cards, Narcos, Sweet Home, Ozark, and even animation like AAAGBS of the likes. But what happened to Blockbuster? We don't hear about them anymore. Why? Because Blockbuster failed to strategize and change over time at the right moment. When they started to re-strategize, it was already too late and is what it is right now unheard. Netflix is very successful that it even spanned other successful competitors such as Disney+, Amazon Prime Video, and HBO Max, providing how lucrative the streaming services business model is. When we talk about company strategy, there will always be a core, and the core of a company's strategy is business model. Elements of a business strategy are customer value proposition towards the brand and products provided, and another element is profit formula. Does the business give profit? But how can we be sure that the strategies applied is a winning strategy? Well, there are 3 types of tests that we can do to see that. And they are the fit test, the competitive advantage test, and the performance test. First up is the fit test. How well does the strategy fit the company's situation? Like, does the financial strength, capabilities, brand, and image fit with the strategy? And the second one is the competitive advantage test. Is the strategy helping the company to achieve competitive advantage, and would the competitive advantage be sustainable for a time? To simply put, look at Netflix. They achieved competitive advantage and as to date, soared and sustainable while providing the company with a large market share. The last test that we can apply is to test whether the strategy is a winning strategy is by assessing the performance test. Is the strategy producing superior company performance? These are the 2 indicators that can be measured, and they are competitive strength and market standing, profitability, and financial strength. Looking back at Netflix, we can see that Netflix soared in performance tests as the company has a big market share and strong financial strength. But all in all, crafting and executing strategy are important because good strategy plus good strategy execution would equal to a good management of the business. What is good will result with something good. Further in-depth discussion will be shared in another part of Strategic Management series, so stay tuned. But in short, strategy is to gain competitive advantage, which would bring profitability to the company. And I, Donorings, would hope to see you in another part of the series, and we will continue in Chapter 2. Thank you for watching. Bye-bye.